Welcome back to The Explainer. Okay, we're going to jump right into it today. We are cutting straight through the noise and unpacking one of America's most iconic companies, the Home Depot. But look, we aren't just talking about a big box retailer today. We're going to examine the anatomy of a literal fortress in the home improvement sector. I absolutely love diving into topics like this, because in a market that's just constantly full of hype and volatility, Home Depot's data paints a picture of a real beacon of stability and operational excellence. So let me ask you right out of the gate, what's your primary focus when you're building out your portfolio? Are you hunting for reliable dividend income to generate cash flow, or are you chasing resilient long-term expansion? Well, what's really fascinating here is that Home Depot actually merits serious consideration for both. Whether you're building a core holding for the next decade or looking for growing passive income, the underlying numbers tell a pretty incredible story. Here's a quick look at our blueprint for the explainer today. We're going to cover building the fortress, weathering the market, engines of expansion, shareholder returns, attractive entry, and wrap it up with the bottom line. All right, part one, building the retail fortress. Looking at the foundation. $164.7 billion. That is Home Depot's fiscal 2025 sales figure. To put that kind of massive scale into perspective, their revenue is larger than the entire GDP of many small countries. And what's absolutely crucial here is that this represents a 3.2% year-over-year growth. Adding that kind of incremental revenue at this sheer scale, it's a remarkable feat. It firmly establishes Home Depot's absolute dominance as the world's largest home improvement retailer, operating over 2,300 stores and employing nearly 500,000 associates. But you know what's crazy? That massive revenue isn't even the end of the story. While they hold an estimated 17% market share, which is a dominant slice for sure, 83% of the U.S. market remains highly fragmented. We're talking about a $1 trillion plus addressable market. The runway for growth here is vast, mainly because Home Depot has the scale, the optimized supply chain, and the sheer purchasing power that smaller independent rivals literally just can't match. So how exactly are they capturing that market? Well, it really comes down to two distinct customer bases, the DIY homeowner and the professional contractor or pro. Now, DIY is what we all know and love from our weekend projects, right? But the pro segment, that is the true high-octane engine of this fortress. The high-value pro customer shops up to 60 times a year. This segment alone contributes around $90 billion annually. They bring much higher average ticket sizes and incredibly sticky repeat business. Moving on to Section 2, navigating a tough market and structural resilience. Look, the recent macro environment hasn't exactly been a walk in the park. We've all seen elevated interest rates, a sluggish housing market, cautious consumer spending. But despite all of those headwinds, they maintained an adjusted operating margin of 13.1% and pulled in $2.57 billion in fourth quarter earnings alone. But honestly, the standout metric here is the return on invested capital, 25.7%. This basically means for roughly every dollar they put into the business, they are generating an incredibly efficient quarter in return, literally wringing value out of investments even in a really tough cycle. So, the real key is how they adapt when big-ticket DIY spending gets soft. And their answer? They lean hard into predictability. By expanding the pro ecosystem through organic growth and major strategic acquisitions, like SRS distribution, for example, they're directly targeting higher predictability and larger project volumes. It's just a brilliant strategic pivot that offsets that cyclical softness on the consumer side by locking in the highly lucrative professional market. Section 3. Engines of future growth. How they are fortifying the future. Now, management's near-term EPS guidance might seem a bit modest, but the underlying structural advantages fuel some incredible long-term compounding potential. Home Depot is pulling several massive growth levers right now. First up, further expanding that pro customer base with dedicated sales teams and faster delivery. Second, heavily innovating through digital and AI. Third, expanding their physical footprint. They've got about 15 new stores planned for 2026. And finally, capturing more market share in a North American market that tops $950 billion. Think about the demographic trends alone here. We have an aging housing stock that desperately needs maintenance and upgrades. As interest rates eventually stabilize, all that deferred home improvement demand is just waiting to be unleashed. And what's really fascinating is exactly how they're pulling this off. Home Depot isn't just slinging hammers and paint anymore. They are aggressively investing in cutting-edge tech, things like Magic Apron and Agent AI. Powered by major partnerships, like their work with Google Cloud, these tools are totally transforming the customer experience. They're reducing friction for both the weekend DIYers and the pros by enabling faster bidding, seamless project planning, and instant material list building. This is absolutely not a tech gimmick. It's a deeply calculated move to drive loyalty and capture a massive share of the customer's wallet. All right, Section 4, Dividends and Shareholder Returns. The Yield Fortress. When you dig into their dividend history, there is one number that just jumps right off the page: 156 consecutive quarters of payouts. Guys, that's almost 40 years. It is a stunning testament to the durability of their cash-generative business model. Following a recent 1.3% bump, the dividend currently sits at $2.33 a quarter, which offers a forward yield of roughly 2.8 to 2.9%. With a 5-year growth rate hovering around 9.5% and a very healthy 65% payout ratio, they offer a highly reliable, growing income stream that's completely backed by sheer operational excellence. Section 5, Valuation and Attractive Entry. Let's assess the price. As of early May 2026, we are looking at a current share price right around $324. That gives Home Depot a market capitalization of approximately $323 billion. At this price point, the trailing P/E ratio is sitting roughly around 22 to 23 times earnings. Now, when you factor in their economic moat, that impressive return on invested capital we talked about, and their huge runway for future growth, many independent models actually suggest this is a very reasonable and potentially even modestly undervalued entry point for a compounder of this quality. Looking at the current analyst consensus, the average 12-month target sits way up around $419. With the high-end targets reaching all the way to $470. Across over 30 analysts, the consensus is strongly bullish, implying a potential 25 to 30% upside. We're simply and objectively reporting the source data here, definitely not taking a stance, but the street clearly feels the current valuation is building in a lot of caution today, while offering some really asymmetric upside if housing momentum actually accelerates. Finally, Section 6, Risks and the Bottom Line. Are there cracks in the wall? Look, no investment is without risk, right? Even a fortress is still subject to the elements. And the key risks detailed here are definitely significant. Housing and consumer cyclicality naturally impact a home improvement retailer. There's just no way around that. There's also the constant threat of margin compression if rising costs end up outpacing their pricing power. Plus, they really have to flawlessly execute these complex digital and acquisition initiatives, not to mention potential geopolitical or tariff impacts on their global supply chain. However, the source material ultimately concludes that Home Depot's formidable competitive position, their management team, and an incredibly strong balance sheet make these risks highly manageable for long-term, patient holders. So that leaves us with the ultimate question for today. Is Home Depot sitting on your watch list? We've just unpacked a really high-quality compounder, a business quite literally designed to weather downturns, deliver steady growth, and return capital consistently. If you are focused on building wealth over years, the concept of dollar-cost averaging into a fortress like this presents a genuinely fascinating case study in retail dominance. Please remember, though, this explainer is strictly for educational purposes. It is not financial advice. Always do your own research or consult a professional advisor. But I would absolutely love to know what you think of the data we've covered today. Has this changed how you view the home improvement sector? Keep learning, stay curious, and I'll catch you all in the next explainer.